All right, folks, time to talk about Chapter 6. So in Chapter 6, let me turn my little highlighter on here. Highlighter. Chapter 6, we're going to talk about merchandising operations and the multi-step income statement. Okay, so a couple things we haven't looked at before, but just pay attention and I'm sure you'll be just fine. All right, so the first thing we're going to talk about, what's the difference between a service business and a merchandising business? Okay, so we'll take a look. There's some differences here. Okay, so the first thing, if you take a look here, service companies, right? Service companies, they sell services and then they collect cash. They pay their operating expenses and it's kind of like this cycle. Okay, so basically what's important to know is that there's no inventory. Okay, so here, where are you? Where are you, Mr. Penn? Oh no, we're not going to write in yellow. Hold on. Let's write in blue. No inventory. Okay. So no inventory, okay? There's nothing, you're not selling a product. You're selling your skill, your service, like a CPA or attorney, something like this, cleaning service, okay? Now for merchandising companies, okay, it's a little bit different. What they do, they buy inventory, they sell the inventory, they collect cash, they pay all their expenses, and it follows through like that. And that's how, and again, this is like Walmart. You walk into Walmart, they got stuff on the shelves. That's how they make their money. They sell that stuff to you, right? So here's an example they give you. Planet Fitness, okay? So notice again, title of the company up at top. This is a balance sheet, part of a balance sheet anyway. And they give you what day it's from, right? So notice if you take a look at their assets, notice there's no inventory, okay? No inventory. So, and over here on Walmart, same thing, balance sheet, name of the company, the date. Notice you'll see inventory here. And by the way, look how inventory is such a huge number compared to the other. Okay. Now, if you stop and think about it, it's because all that stuff that you see sitting in the stores had to be paid for or bought, or they're going to pay for it later. But they have all this inventory, right? So that's a big deal. Okay. And then on the income statement, notice they have service revenue, okay, here. Service revenue means they did some work. Well, in this case, they let people use the fitness center, right? But over here on the income statement for Walmart, notice they have cost of goods sold. So they have the revenue that they made, but they had to subtract the cost of goods sold to get to their gross profit, okay? That's the difference between the two. Okay, so here we go. Question number 1 for your quiz. Based on the balance sheet alone, how can you determine if a company is a service company or a merchandising company? Okay, so there you go. Hopefully you'll know the answer to that. We just went over it. Okay, all right. Now, the next thing we're going to take a look at has to do with the differences between periodic and perpetual inventory systems. Basically, how are you doing your inventory? Okay, there's 2 different methods. We're going to focus on perpetual. Periodic, nobody really does anymore, and I'll explain that to you as we go through. Okay, all right. So inventory systems, okay, so they're pretty important. So inventory is the merchandiser's total cost of acquiring the goods that it has not yet sold. Okay, so in other words, all that stuff sitting on the shelf in Walmart, right? They had to pay for the item. They might have had to pay the charges to get it shipped to them, right? So that's the inventory, the cost of all that stuff. Now, the sales revenue, that's what they sell it to you for, okay? That's what they sell it to you for. And then the cost of goods sold, that's the cost of the items the merchandiser sells to the customers. So, for example, you walk into Walmart and buy a pair of jeans, right? Well, let's say you go in there and you pay $30 for the jeans, right? Well, not all that money is profit to the merchandiser, right? To Walmart. Can't be, because they got to pay for the jeans, right? Let's say the jeans cost them, I don't know, 20 bucks. So you got, basically you would have like this, right? You would have essentially, you'd have revenue, right? They sold to you for $30, right? Then you'd have cost of goods sold, $20. And so then you would have profit of $10, or actually gross profit, not net. Gross profit meaning you still have to pay for all the employees, the electric, all that kind of good stuff, insurance, okay? So inventory systems are kind of important, and these are the terms that you're going to need to know, okay? All right, so taking a look at this, notice we start here with beginning inventory, right? $4,800. Then we purchased $10,200, right? So if you take 4,800, you add 10,200, then you have a total of $15,000. This is all the merchandise you have available for sale. Okay, so notice goods available for sale, 15,000, right? Now, let's say we sold $9,000, right? That's going to be on the income statement as cost of goods sold, right? It's going to be on the income statement. And the ending inventory, what's left, that's on your balance sheet as an asset, okay? So cost of goods sold, by the way, cost of goods sold is a type of expense. Kind of a special one, but it's a type of expense. Okay? And on the balance sheet, you got inventory, and inventory is an asset. And we just saw that before. Okay? Now, what they're showing you, these formulas, you can memorize them if you like. I don't really think it's necessary, but what this is beginning inventory plus purchases minus ending inventory gives you cost of goods sold. Or you could do beginning inventory plus purchases minus cost of goods sold gives you your ending inventory. It's like solving for the unknown, right? All you have to do is whichever one you don't have, you can use the other three to get it, okay? Now, periodic inventory system, this one we're not going to cover in great detail, and I'll tell you the reason why, okay? So periodic inventory system. For a periodic system, what that means, in order for your inventory records to be accurate, you only know at the end of the accounting period. This is kind of like old school where you had to go and count what was left, okay? Require the inventory be physically counted, right? So this is, imagine an old country store somewhere not working with computers, okay? So they want to know, well, how much, let's say they had 10 cans of beans up on the shelf, right? And at the end of the month, they're like, well, what's our cost of goods sold? They don't have a computer. They go and they count, and they're like, okay, we have 4 cans of beans left. That meant we sold 6 of them, right? And we sold them for $1 each, and they cost us 50 cents each, right? They literally have to go and count. This is a very old type system, but only the smallest, and it's very rare these days that anybody uses it. And the reason why is because you don't have information you need to run a business these days, okay? That's why we're not going to focus on it too much, okay? All right, so based on the prior descriptions, in today's business environment, do you think most companies would use a periodic or perpetual inventory system, okay? Periodic or perpetual? Go ahead and answer that question. Make sure you write it down so you can put it on your quiz. Now, perpetual inventory system is exactly what it sounds like. The inventory is updated perpetually. Now, what does that mean? Okay, so let's go back to Walmart. You're buying that pair of jeans, right? So you go up to the counter. They scan the jeans. You know how they scan it with that I don't know, a little scan thing, right? It reads the barcode. So they know that right then it's registering what you bought and what was sold. So it automatically deducts it from the inventory. This way, a company can go and they can check on their inventory system and say, yeah, we have 10 more pair of pants this size in stock. And also that barcode could also tell you what size it is as well. So you could see, could you imagine a Walmart with all the clothes and different things that they sell, how impossible it would be to use a periodic system. Okay, so notice it's often with scanners, optical scanners, barcode readers, right? Okay, this is all, by the way, everything these days. It's on, you go look at the size of a can of Coke or whatever, you'll see that barcode on there. And again, this is so you're able to do the inventory. All right, folks, that's part one. We'll be back with part two in just a moment.